the buyback, one of the things that has been jacking the stock market, up and up and up, and the market is up again today, although it went down for a couple of days after Trump announced that he was going to, put tariffs on China, and China let their currency, they let the yuan float above 7 to the dollar. Which spooked the markets and all that kind of thing. But basically, one of the major things that has been driving this market increase in price is that over the last year and a half or thereabouts, publicly traded companies in America have used their tax breaks. Donald Trump gave them and their billionaire buddies a $1.5 trillion tax break. And they took $1 trillion of that. They took 2/3 of that money and literally used it to buy shares in their own company and retire those shares. So what that does is, as the number of shares say you've got a company that's got, 100 shares. We'll make numbers really simple. You've got a company that has 100 shares out in the marketplace, and those shares are selling for, let's say, $100 a piece. 100 shares at $100 a piece. You got a company that's worth 100. That's worth, what is that, $10,000, I guess. So 100 shares at $100 a piece. If the company buys back, say, 20 shares, there's now only 80 shares in the marketplace, but the company is still a $10,000 company, which means that those 80 shares, instead of being worth $100 a piece, are now worth $120 a piece, roughly. I mean, I realize my math is... Anyway, so you get my point. When companies buy back their shares, the outcome of that is that the price of the company's stock goes up because it represents fewer shares. So and so what they do is they issue all these stock options to their employees, particularly their senior employees and their CEOs. They pay them in stock options, something that was legalized during the Reagan administration. It used to be illegal. And so you've got the CEO of the company sitting on 1 million shares of stock that he's got an option on. What that means is he has an option to buy it at a particular price. So when he got that stock option, say 5 years ago, the price of the stock was $75. Now the price of the stock is $100. But whenever he decides to exercise that option, that means he can buy those shares at $75 and he can sell them the next day at whatever the market's at. So what he does is he says, I'm gonna exercise my stock option the day after tomorrow, but today what I'm going to do is I'm going to have my company buy back 20% of its shares. Actually, it's more like 1 or 2 or 3 or 4% of its shares, if that. But we're going to have the company buy back shares. It's going to drive up the stock price, and then I exercise my stock option. I make a fortune. So that's how it's worked. Now, the top story on Axios' market newsletter today: the buyback slowdown could spell big trouble. After buying back more than $1 trillion of their stock last year, public companies are slowing share repurchases, and that will make trouble for the markets. And I don't think I have to go much beyond that. You can see exactly where this is leading.